Apple and Tesla, which is a better long-term investment? Apple and Tesla are arguably two of the giants in the tech space. That said, tech enthusiasts are wondering which of the two makes a great investment in the long term. You definitely would not want to miss this. Several years ago I said, I think on our earnings call, that I thought it was possible for Tesla to be worth more than Apple, which was then the highest cap company I think in the market, says Tesla CEO Elon Musk during the Q3 2022 earnings call. However, which of the two companies would be a better investment? Tesla and Apple have very little in common, except for the fact that both stocks are top 10 holdings in the NASDAQ composite and have been exceptional investments over the past decade. But while Apple stock held up better than the NASDAQ in 2022, Tesla stock has gotten absolutely crushed, down 73% in the past year. Timing the purchase of Apple stock well would have produced gains of over 370,000% between 1982 and now. That is to say that the inflation-adjusted equivalent of about $3,000 invested back then would have been worth around $1.1 million now. Over such a long period of around 40 years, it is hard to find another stock worthy of dethroning Apple as the wealth-producing king of our generation. That said, Tesla stock has been at least as impressive at producing astonishing returns, albeit over a shorter time frame. Since the EV company became publicly traded in 2010, Tesla shares have appreciated a whopping 9,330%. Over the past 12 years, it is not even fair to compare the performances of Apple and Tesla. The latter has turned a nominal initial investment of $1,000 into $94,000 today, while Apple investors would have ended up with $17,000 instead. Historically, Tesla has been the better growth stock. This is also evident in how much more volatile and susceptible to large drops Tesla has been relative to Apple stock. It is important to keep in mind that a key trait of growth stocks is both high risk and high reward. An example is Tesla's annualized volatility since 2010 has been 63% versus Apple's 28%, and Tesla's worst drop from a peak since 2010 has been 61% versus Apple's 40%. Still, experts believe that Tesla is going to outperform Apple over the next 5 to 10 years. So when it comes to which is the better buy, it would be Tesla. However, Tesla is a far more volatile, risky, and stressful investment, and for that reason, it's a stock that's probably best avoided if you don't want to deal with the drama, if you have a shorter time horizon, or have a lower risk tolerance. What makes Tesla such an exciting stock right now is that its fundamentals are finally catching up with the stock price. The argument that Tesla is being priced for what it could become far into the future isn't as easy to make now that the stock has collapsed. Whether you love it or hate it, Tesla has undeniably grown to become a very good company. It has an industry-leading balance sheet, operating margin, top and bottom line growth, and free cash flow. And a lot of those strides have come in the past 2 to 3 years as Tesla has gotten more consistent with its profitability while keeping up its torrid growth rate. For those that think Tesla is just a car company, then production and deliveries would have to grow several times to justify Tesla surpassing its previous all-time high. But if you're in the camp that Tesla can monetize its electric semi-truck, robotics, and autonomous and self-driving technology, and grow its renewable energy business, could follow in Microsoft's footsteps and be a completely different company with a much higher valuation. All told, the risk-reward for Tesla makes a lot of sense at these levels. However, those who choose to invest in Tesla would have to be prepared for a bumpy ride. On the other hand, other experts believe that Apple has a better valuation. In fact, the sell-off in Apple shares has the stock valued below the $2 trillion level for the first time in nearly 2 years. It also marks the same market capitalization at which the stock was trading back in August 2020. After Apple has lost 1/3 of its value in the past year, many believe that now is a good time to buy Apple shares. Recent concerns have been that shipments of the company's new iPhone 14 Pro have dropped due to manufacturing struggles in China and that demand could be lower as consumer spending slows in the current economic environment. That has also led some analysts to lower estimates for sales of iPads and Mac computers, adding to concerns about lower earnings. That scenario does add short-term risk to buying the stock now. But the Apple ecosystem remains a great long-term business. The company generates tons of cash and returns to its shareholders in the form of both dividends and share repurchases. Those stock buybacks have reduced Apple's share count by more than 20% over the past 5 years. That gives existing shareholders more of a stake in the iconic company. With Apple's stock price drop, it is now trading at a better valuation based on the price-to-earnings ratio that has been seen in almost 3 years. Even if earnings growth stalls this year, a PE of around 20 represents a good level to own this proven company without the risks associated with other less mature technology and growth companies. However, comparing Tesla, a fairly young company, against a far more established company like Apple may not be fair. It probably makes the most sense to contrast Tesla's performance in the past 12 years to the first 12 years of Apple as a public company, between 1980 and 1992. But even in this sense, Tesla looks much more like a growth stock than Apple, at least historically. From 1980 to 1992, Apple returned a decent 13% per year. An initial investment of $1,000 would have grown to $4,385 in 12 years. From 2010 to 2022, Tesla returned an astounding 43.8% per year. As mentioned above, an initial investment of $1,000 would have grown to $94,000 in 12 years. It is worth noting that Apple did not have an easy start as a publicly traded company. In addition to facing a recession in the early 1980s and another in the early 1990s, Apple nearly went bankrupt at one point. The return of Steve Jobs as CEO and the launch of the original iPhone in 2007 was needed to finally turn the company's fortunes around. That said, it is easy to see that historically, Tesla has much more of the growth DNA than Apple. But investors tend to be forward-looking, so we should consider future growth opportunities as well. Apple could be seen as a growth company due to the untapped opportunities in areas like mixed reality, the metaverse, and even autonomous electric vehicles, Tesla's wheelhouse. Of course, one must believe that these growth avenues could become game changers for Apple. When it comes to the current product and services portfolio, it's hard to see how smartphones and laptops may provide much of a growth path for Apple over many years. It is probably easier to see the growth argument for Tesla. The company has been revolutionizing the automotive industry. According to Statista, sales of battery and plug-in hybrid EVs should more than double between 2022 and 2027, and Tesla is the industry leader. This is not even to mention the other opportunities that Tesla could explore. These include battery applications outside the automotive industry and driverless technology in public transportation, including the anticipated autonomous taxi. Diving right into the argument, according to Y-Charts, sell-side analysts believe that Apple's EPS will continue to grow over the next 5 years, but by only 11% annualized. On the other hand, and off of a much lower base, Tesla's EPS could climb by an annual rate of 29% over the next half-decade, according to Wall Street. Clearly, Tesla looks much more like a growth company than Apple, at least based on the expected bottom-line trend. From a valuation point of view, Tesla better justifies its status as a growth stock by trading at a next-year PE of 26x, much lower than the 80x of early 2022, as the share price has tanked lately. Apple, on the other hand, commands a lower forward earnings ratio of 20x. Tesla and Apple could both fall quite a bit more, but there are excellent reasons why now is a good time to own either company. Tesla and Apple are in great shape to handle a recession, even if it means short-term margin compression and slowing growth. Each company also offers a path toward multi-decade growth by expanding the core business and also monetizing new investments. For Tesla, long-term growth means expanding its electric vehicle offerings outside of passenger cars and making money from software and robotics. For Apple, long-term growth means selling more consumer electronics while also growing its services and financial products, like Apple Pay and Apple Card, and its entertainment services like Apple TV and Apple Music. Overall, there is a lot to like about adding shares of Tesla or Apple to a diversified portfolio. Make sure to subscribe to this channel for more Tesla stock updates.